My name is Rachel, and you're listening to Multifamily on Fire. Thank you for joining this meetup where we're basically trying to help you guys learn how to buy multifamily properties and be able to gain financial freedom and retire early. That's the point of Multifamily on Fire. And today we have Adam Adams back again for our fifth part of our six-part Multifamily on Fire series. And if you do not know, if you're first time joining us, he has partnered in seven multifamily properties, syndications, 1,400 doors valued over $100 million. Thank you, Adam, again for joining us today.
Thrilled to do it.
Yeah.
To do it.
Thank you. And so today, part 5, what we're going to be talking about is the creative ways to buy multifamily properties. And I've actually spoke to some people before we started this call tonight who were saying, you know, they want to get involved, but they just don't know how, or they don't have the money. And so I know there's a few creative ways where you can use other people's money, which I found was really interesting. And I'm curious to know your experience with that, if you have any experience with that, Adam, and if you can explain to us all the creative ways that you know about buying multifamily properties.
Yes. Thank you. Thank you for having me. I love Multifamily on Fire. You guys are crushing it. I'll say for the recording, you might want to be super close to your mic. It'll have a really good sound for anybody later on. But I'm always, what's the word for it? I'm always so, anal retentive about the mics because I'm a podcaster, and that's all just a bunch of sound, and you can't always see people. People don't notice it when you see them, but when it's like on a podcast, I'm always thinking of it. So sorry to go into that.
No, it's fine.
All right. But as far as like creative real estate for multifamily, just every single deal that I've done has had creativity, 100%. The first deal I ever did, the creativity was that I got a private money lender to buy the whole multifamily property. And then then after they closed on it, then they transferred title to me, and they gave me a note. And I was paying a mortgage, not to a bank, but to this guy who I had met, who seemed like he wanted to invest in real estate. It was a fairly inexpensive property compared to what we buy now. What we buy now is in the $10 million range. But back then, my very first one that I bought was only $385,000. And so we purchased that, or he purchased that. And then he created a piece of paper that basically called an IOU. It's a note. It's just a piece of paper that says that I need to pay him every month a certain amount until I own it myself. And so that's what we did. And you know, here's why I did it. We can do creativity for lots of different reasons. The reason I did it was because I couldn't qualify for a bank loan. My business was too short. I even had pretty decent credit, and I was making okay money, but I didn't have my business tax records for 2 full years, and so the bank wouldn't give me a loan, and so I just had to call a bunch of people until I found a way to buy that. So the lesson in that part is there's always a way. If you want something bad enough, it doesn't matter what the bank says. You ask enough people, one of them's bound to say yes. So that was kind of like a seller finance. Mm-hmm. And then other creative deals that we've done. Here's one. I partnered with one person. His name is Steve Gillis. I partnered with Steve. And Steve and we purchased 3 houses, and for all cash was $45,000, for crazy inexpensive. They weren't in the best market, and I wouldn't suggest everybody on the call buy those exact things, they have worked out for us, but most of the things like this haven't worked out. Most of the cheap houses have not worked out. However, this is how we worked it. We bought the 3 houses with his cash, and so we were 50-50 partners. I found the deal. I managed the deal. He was the money person, 50-50 partners. He does nothing. And all of a sudden, we own 3 houses. And I know that first one was single families, but check out what we did after. Then I reached out because we've talked about in parts 1 and 2 and 3 and 4. We've talked a lot about how important it is for you to have influence. It's so important for you to have influence. It's the best way to find more deals. It's the best way to find more private capital. So I sent an email out to my meetup group, and I just said, would anybody want to put a private note on these 3 houses? I'm looking for somebody to spend $45,000, and then that's a refi for me. That's gonna take my cash that I put into it, so I can buy something else. So that's what we did. A woman named Camila reached out, and Camila wrote a check directly to us and created a note, a promissory note. And she filed that note against the 3 houses, 1 note against 3 houses. And then what we did was we took this $45,000 and we bought a 4-plex for all cash. And then we refinanced that out with somebody else's money. And then we did it on a 3rd one. We bought another multifamily, and for all cash. And then later I got a friend, somebody that I knew, somebody for my meetup. And I said to them, hey, would you like to make 10% return on your money by having a note against this property? She said yes. And so we pulled the money out. It was so cool because for the same $45,000, the exact same $45K that we ever started with, we bought 23 doors with that. We bought a 5-plex, a 4-plex, a 3-plex, 3 houses, 2 more houses. And I think that's it. So I hope that adds up to 23, because I was pretty sure it was 23. So somebody do the math. 5 plus 4 plus 3 plus 5. 5, 4, 3, 5. She's doing it.
Look, don't give it. I lost count.
and then we bought a 16-plex after. Okay, so it's not
17.
23 doors. Thank you, Dennis.
Thank you, Dennis.
So 17 doors. But all with the exact same money. All with the exact same money. And then that was a creative strategy. So there's 2 creative strategies. The 3rd one that I think we should talk about is what I do now, which is just syndication.
Okay.
So in the beginning of syndication, we were overwhelmed, like trying to raise other people's money, that much money. Of course, I've been doing this since 2005, raising different amounts of capital from different people for different properties since 2005. But all of a sudden, we're talking about multi-million-dollar projects. We're talking about filing this directly with the Securities and Exchange Commission. You actually file an exemption with the SEC to show them that you can legally raise money. You have to do a lot of things right. You have to pay a lot of money to do it. But what's rad is some of the properties that we close on, it's hard to believe because it's a lot of money. But sometimes when we close on a deal, we actually, even though there's expenses beforehand, like we'll need to spend maybe 15 or 20,000 with our attorneys. We'll also need to pay somebody to come and look at all couple hundred units and inspect every unit. We'll have to fly out there a few times. We'll have to rent cars. So there can be a lot of like upfront expenses. Plus, we have to put what's called an earnest money deposit, EMD, where we actually have to put some money, a lot of money. Usually it's 1% of the purchase price. So On a $10 million property, the minimum is $100K. So you got to put that $100K out. Okay, so all of this sounds bad, but here comes the good part. The day that we close it, we get our $100K back. We get all the money that we paid the attorneys all back. We get all of the money for the due diligence back, all the money that we spent for hotels and flights and even food, all comes back. And on top of it, on top of all of those things, we also get a 3% acquisition fee, which means if we buy a $10 million property, the day I close it, I will actually make 300,000. I'll get all of my money back that it took me to get to this place. Plus, we will make 300,000. So it sounds crazy, but let me explain why we get that 300,000 the day that we close. There's a lot of work to put it there. There's risks to put it there. There's time, there's attention, there's a team, there's all of this stuff that it takes for you to find a bunch of bad deals and not close on them so that you can find a good deal and close on it. So what I'm saying is it takes time and effort to do all of that. So we charge the whole team an acquisition fee to cover all those costs and to help us, to incentivize us to keep looking for new deals. But the money, so not only do we make money, but usually the money that closes the property, is all other people's money. So it's called syndication. So we do these with a 506B or a 506C, but on the bigger properties, creative strategy that we've done is to file with the SEC, write all these documents after doing due diligence, and we reach out to people and we give them an opportunity to make money on their money. So once we know that we've got a solid deal, we bring it out and we say, hey, we've got a deal. Do you want to be a part of it? And what's funny is I used to think, man, if I want to close a $10 million property, I need money. Mm-hmm. I used to think that way. I used to think like, man, if I don't get this money, I'm going to be embarrassed. I'm not going to be able to close. I'm going to lose my earnest money if I don't close. And it was very self-centered in the beginning. When you first start thinking about raising equity, a lot of us, we start thinking, man, I need to do this. I need to do that if I don't have this. So I want to suggest to you first off that you start being outwardly, not self-centered, but focused on other people, mm-hmm. other people's money, other people's opportunities, where you're there and you literally have an opportunity to say, hey, do you want to be a part of this and make money on your money? And what's amazing is most people do. Most people want to make money on their money. Most people want to be able to sit back, not have to deal with any of the tenants or toilets or termites or phone calls at midnight. They want to sit back and know that you will operate it all. Once I finally learned that, that it's not me needing money, it's them needing an opportunity to invest in, it switched my whole demeanor. It made it so much easier to raise money because I was confident. I was more helpful for them, and I wasn't nervous or stressed. If I don't get this, then blah, 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 blah. Mm-hmm. So that's syndication, or that's a short version of what syndication is. But I've been able to close, Rachel's mentioned on the beginning of the show, 1,400 units. Remember we were talking about those first 17 units that I did with the same 45 grand? Mm-hmm. Well, now I have 1,400 and I've done all that with the same, 300 grand that my team started with. Dennis asked about the front costs of EMD mm-hmm. and the closing costs. Do you get that back? You get it at closing. And so what we do is in the private placement memorandum, okay, there's the Coca-Cola, they take their company public. Coca-Cola gets investors by going public. I get investors by going private. Okay. So we call it a private placement memorandum. It means I'm not traded on the stock market. I have to go to individuals. And so to answer your question, Dennis, when I create the PPM, private placement memorandum, the documentation that shows that I can legally raise money, kind of like going public, when I do that, we actually write into the closing documents that the earnest money was a closing cost for the whole property, and it needs to be paid back to the operating team. We write in that the attorney's fees, which are usually somewhere around 20,000, 15 to 20, those go back to us. All of the due diligence costs go back to us, and we charge a 3% acquisition fee. Sometimes it's a lower, sometimes it's higher. On a small property, you're going to charge a 5% acquisition fee. On a huge property, you're going to maybe charge 1 or 2%. But on most of them, if it's 5 to 10 million, you're probably going to be charging 3% acquisition fee. So Dennis was wondering, do we get that upfront cost back at closing? Yes. The day that we close, the money goes from the I'm trying to think of what the bank account is called, escrow.
Mm-hmm.
The money comes out of escrow. A lot of it goes to the lender because we need to do 20% down. And then the rest, a lot of it goes into a bank account for the new LLC that owns the property because it needs to have working capital. And then the rest, a chunk of it comes to us to replace our the fees that we actually spent, like the EMD. And then another chunk of it comes to us as an acquisition fee. It comes all out of escrow the day that they close. The escrow attorney, the title agent, they write all of those checks and disperse the money all at once. And if you don't close, the money is still safe in escrow, and they don't disperse it. You have to close in order to do that. So, yeah.
Good. There was another creative strategy that I've heard about, and I don't know, do you know anything about master lease agreement?
Yeah. Awesome question.
Mm-hmm.
I know enough about master lease to get us started,
Mm-hmm.
but I haven't done one yet.
Okay.
So a master lease is awesome. This is, and actually there's another one that I have done that I can share.
Okay.
So there is something, let's talk about master lease, and then I'll briefly talk about a loan assumption, which we've done multiple of those.
Okay.
So the master lease, what all it means is the owner of the apartment building continues to own the apartment building. And we become basically the managers. We start paying the owner a lease amount, but we do all of the work and we do all of the rest. So there's 100-unit apartment building, well, nice round number, 100 units. Let's say that this property is $10 million. And we don't feel like we should pay 10 million right now because there's some problems with the property. There's some issues with the property. And so what we do instead is we negotiate with the sellers. How much is your mortgage? They tell us how much their mortgage is. If they don't have a mortgage, we say, how much do you need per month to net from this? And if we can come to terms, we write a master lease with option. So we write a master lease, which basically says that I'm going to pay you, the owner, let's just say it's $10,000 a month. I'm going to collect $200,000 a month from gross income, and I'm going to work with it. I'm going to use it as capital to spend, use for improvements, do whatever I need to do to keep the property floating, keep some for myself usually, but I'm going to make sure you get your 10 grand a month or 20 or 30 or 50 or whatever we negotiate. Um, and then usually the master lease is going to have a second document, which is an option. It's an option to buy. So I'm going to manage the property. I'm going to, and you're going to still own it, and I'm going to pay you a master lease price, and then I'm going to collect the leases or rents from everybody else. But generally, a master lease has an option to buy. So that means you might set up a barrier, a hurdle that you will achieve. And you'll say to the seller, you'll say, look, as soon as I have an opportunity, as soon as this property's bringing in 300 a month instead of 200,000 a month, as soon as that happens, then it's going to be worth this amount and I'll be able to qualify for a loan. But I can't qualify for a loan with the low income that you've been having so far. So I get in there and I manage the property until it's worth more, and then I can buy it for a certain price that's agreed upon. So that's a master lease with option. That's pretty much how it works. I've not yet done it myself, but we've done something kind of similar. It's called a loan assumption. Now, a lot of people on the call, they might say to themselves, no, there's no way you did a loan assumption, Adam. Loan assumptions don't happen anymore. That was 1990s. You can't do a loan assumption now. And that's probably true because you have been doing single family for a long time. And you understand that it's more subject twos now and owner financing or wraparound mortgages versus a loan assumption. You might understand, hey, it's really going to be more of a lease. It's going to be a subject to. But what's crazy is single family and multifamily are different. With multifamily, you actually can assume a loan. So the loan used to be in their name and the property used to be in their name. And they can actually, with most types of debt, if it's for larger properties like this, they allow you to assign that loan into a new name. I can assume it. I don't have to go and qualify for a brand new loan. I just take over the loan. The times that this happens is when there's a prepayment penalty, like they call it maintenance, or I think I'm losing the term for it. It might be maintenance, loan maintenance. It's basically they have a prepay penalty. Deficiency. Okay, they have a prepayment penalty. So that means the loan terms are like a 10-year term or 5-year term, and somebody wants out of the property, but they still have 2 years left. So if I wanted to buy that normally, if I wanted to buy that property, the lender is going to charge them $1 million or a couple $100,000, which it's not feasible to spend a couple $100,000 on your old loan and me pay a couple $100,000 on my new loan. And so what the banks have done is I can actually assume the loan. I can actually put it in my name. They don't do that for single family. 99% of single family loans will not let you do that. But at least 90% of commercial loans will let you assume a loan. And so we've done that multiple times where we keep the loan in place. And there's three things you can do when you're assuming a loan. Number one, you'll notice that the loan has been getting paid down. Usually the loan's getting paid down over the last few years that they owned it. And usually the property gets more valuable. And so what that ends up doing in most cases is makes it difficult for us to just have this small amount of a loan on a property and have all of this equity, because then our money's not going to work for us enough. And so the three things you can do: A, you can buy the deal and suck up the cost and just have to come out with more money because the loan's lower compared to the purchase price, the sales price. Or two, you can do what's called a supplemental loan. A supplement, this is like in single family what you would call a second mortgage. Okay, so we can get a supplemental loan. So basically, assume that loan, and on Fannie and Freddie, they'll let you. Fannie Mae and Freddie Mac, they are big lenders for big properties. They will actually let you have a second mortgage, a supplemental loan against the property. So you start with the first one, and then you get that second mortgage all on day one. So that's a cool way to do it. The last way you can do it is having the seller carry the other note. So this gets into another creative strategy. So you don't have to just keep the loan. You can also get a supplemental loan, or you can have the seller do a supplemental. Basically, the seller would do a second mortgage to you. So those are three cool strategies. And I was going to share with the supplemental loan. I don't remember, but that's okay. Lots of good info came out of those two ideas: master lease and then loan assumptions.
Okay, thank you. So, you know what? When it comes to doing our due diligence before we submit our offer, can you talk about that? When it,
Doing the due diligence
yeah.
before you submit the offer. I can definitely talk about it. Is there a part of it that you want me to get into more detail on?
Well, I was just thinking if we're doing the creative ways to, purchase and buy multifamily, what are the things we need to look for so that we know that it is something we can do with create those creative ways?
How do you,
Like
so you're asking, is there something
I
that
think
you can,
the way that we actually look up, like I know, like say in residential, you'll like if you were trying to wholesale or do, let's say, subject to or something. But I know,
yeah,
like, let's say we do a master lease, which is it's kind of familiar in a way, but it's like I know we look for people with distressed properties or
yeah,
just don't want it.
yeah.
So it's like, what are the things that we look for that we like? Okay, I don't have the money, but I can do this creative way to get this property. So what do you look for?
Well, one concern with doing a master lease is all of the other ways, all of the other creative ways, they involve a bank.
Mm-hmm.
So, I mean, I need you all to always do your absolute 100% best to be safe when you're buying properties and to do the best amount of due diligence. However, when you are getting a lender to lend money on a property, they do a lot of due diligence for you.
Right.
I mean, you still need to do it, but I'm just saying they kind of are a second set of eyes. But when you're doing a master lease, you don't have a bank doing that. So it gets even scarier. It puts more burden on the buyer to make certain that they're doing as much due diligence as they possibly can. So what to look for? I, you got to look. There's a lot. You got to look at the leases. You got to look at who's on the leases. You've got to verify that those people are on the leases. It's called a lease audit. So you basically double check that everything's square, everything that they said is going to happen, it really is happening. You've got to check the foundation. You've got to check the roof. You've got to check all the plumbing. You've got to check. It's called. There's a boiler and there's a chiller. It's basically the furnaces and the um, and the air conditioners, but it's for bigger properties. But you got to check if they have ACs. You got to check the ACs. You got to check the water heaters. You got to check the flooring. You got to check if there's leaks underneath the faucets. So like open up every single kitchen counter, like look in there. Some people just kind of like look in the kitchen, but you've got to open the bottom of underneath the sink and see if there's any leaking under there, because it's going to cost a lot. So the checklist can always change. Checklists do change. Basically, we have a checklist. I can probably give it to you guys. I want to make sure that I can. It should be in a good spot. What I'll say is just email Adam at realbluespruce.com. So we have a checklist that has, I think I went over like 12 things just now, but our checklist has hundreds, like probably 300 different things that need to be checked, like specific things each unit. But the big ones are the roof. The drainage is a huge one. So you want to make sure that the landscaping, a lot of people neglect this. Even experienced people neglect this. So you see the dirt, the landscaping, the grass or whatever next to the property. If it's draining to the property, you're going to have a lot of issues, a lot of problems. And so you got to be really, really, really careful how detailed you look into that. So then, but if you see a property where it has a grade that goes away from the property that would take water away from the building, you're usually going to be really safe. So if you see all of the grade goes away from the building, you're probably good. If you see that some of the grade comes toward the building, you're probably bad. And the costs for landscaping, it sounds stupid and crazy to even imagine, but it can be hundreds of thousands of dollars to just move dirt. You think to yourself, well, how hard would that be? Just get a tractor and move the dirt. There's a lot involved into regrading to get it away from the property. And there's a lot of distressed properties. If you see a distressed property, there's usually going to have more problems with the roof than the foundation and the grading, the landscaping, the tenants. Oftentimes, if you find a worse property, you have worse off tenants. When you're doing a lease audit to make sure that it's the right person on the lease and they're paying the right amount, you also want to check to see if they paid the same amount of security deposit as it shows on that they should have paid. So you got to verify all of these things. We could spend easily 3 days on due diligence.
Right.
Yeah, there's hundreds and hundreds of things. But I think we went through 20 good ones.
Well,
So.
thank you.